Today we're going to work on 7-2A. And so where we are in the book is on page number 349. 349. Now, here's the big trick of what we're looking at today. Today is pretty messy. There are a lot of moving parts, as you know, in inventory problems. And particularly when we solve perpetual LIFO, when we do that problem, that is out of all the, everything we do, it's the most messy. I guess I'll just stick with that word. So there's going to be a lot going on between where I'm going to start over here, I'm going to finish over there. We can't, I can't work straight down like I did last time. So what you have to do, and sort of what I'm putting on you is, if you see a number pop up, and do this as soon as possible. If you see a number pop up and you're thinking, where in the world did that come from? You got to stop me. Okay, and you got to say, hey, where did that come from? Because I can't, go over every one of them multiple times and all. So if something pops up and you're thinking that makes no sense at all, then I probably explained it wrong. I'll re-explain it again, and we'll make sure that you get it right. So what we're looking at is 7-2A. Now here's a big idea here. You'll notice it says beginning inventory for RTE. This is in the problem. Office supplies and data on purchases and sales for a 3-month period are shown in problem 7-1A. So we're not dealing with brand new information. We're not dealing with new purchases and new sales on different dates and different amounts. Everything is staying exactly the same. The only thing we're switching is what? The only thing we're switching is the method of accounting that we use. All right? Inventory management, logistics, supply side stuff is a big business. You make a lot of money doing that stuff. We're concerned with the accounting side of it. Okay, how do we treat it on our books as far as creating an inventory balance? Okay, so last time we talked about FIFO. FIFO means what? First in, first out. Okay, that sort of follows the natural progression of the way inventory actually flows. Okay, the first inventory that I buy from my supplier is typically the first inventory that I'm going to try to sell to my buyers. Okay? LIFO is the opposite. LIFO is last in, first out. Now, in reality, all right, economically speaking, when items are sold, LIFO is rarely the actual flow. It rarely reflects the actual flow of goods. What I mean by that is this. It is very rare in a business that the actual physical flow of goods follows LIFO. It's very rare that the last things you buy are the first things that you sell. It acts more like FIFO in reality. Okay? LIFO is a pure accounting measure. Okay? It's almost an accounting trick, if you will. Okay? And what we have to know is, if I choose LIFO, how does that impact my books versus choosing FIFO? That's the kind of stuff we're after, in addition to being able to solve the problem. Okay, and we'll talk a little bit more about that as we complete the problem. Okay, but that's the kind of stuff that I'm looking for in this inventory chapter. So, the only business that I can really think of that LIFO would kind of flow naturally is, if you've ever gone down Fortification Street, way down Fort, they sell raw material, crushed brick, dirt, tops, stuff like that. And the only thing I can really think of is, it's this big concrete area, and they just have, all this different kind of crushed rock. And I guess the truck comes in and, takes the layer off and goes and takes it wherever, and then, the truck comes and dumps more on top of it. So the last material that's added to the pile is the first one that goes. That's the only real example that I can think of where LIFO happens in reality, but anyway, businesses do LIFO all the time in accounting, so that's what we're concerned with today. All right, so remember, last one's in, the last ones I bought, first one's out. Ready? All right. Just like last time, our first line starts, it says June 1. And I just have an inventory balance, so I've got date, I've got I need a column for purchases. I need a column for sales. And then I need a column for balance over here. All right, so 1, 2, 3, just like that. And all that June 1st piece of information is telling me, remember we're going back into problem 7-1A and using all that information. All that's telling me is that, hey, on June 1st, somebody went back where we keep the inventory, counted it all up and said, this is what we have on June 1st. There's no purchase, there's no sale, it just is. We're just bringing it over from the previous month. And it says we have 500 units. And those units cost me $30. What's the last word say?
Balance.
Sorry, balance. Yeah. Balance. Handwriting is not my specialty, so I'm not doing handwriting in second grade. All right, purchase and sales balance. We good right here. So when you see that on an exam, you know what to do with that. It's not a purchase, it's not a sale, it's nothing. It's just saying, hey, as of June 1st, here's what we got. $15,000 worth of stuff. Okay? And it all cost me what? It all cost me $30, every one of them. All right? So, we don't have any action on inventory. Remember, accounts want to stay the same. Until we change them, it's going to stay just like this. All right? So June 10th rolls around, and what do? All right, we buy. We're not selling inventory. We're adding to what we have right here. So June 10th comes around, and I'm making a purchase. All right? And what I buy is 1,500 units. And those units cost me $34 for a total of $51,000. So what I did is I spent $51,000. I gave, we'll make this group over here my suppliers. I bought from them $51,000 worth of inventory. They said, hey, it's going to cost $34 per item. Handed them $51,000. Nothing happened over here. We'll sell to y'all. We're going to buy from y'all. All right? So, now, the question we always have to answer is this. After this transaction, after every transaction, what have I got now? Well, if I go over to my inventory storeroom, over here, and I count up everything, what have I got? Well, nothing happened to this. That's still sitting there, all right? So I still have 500 at 30. And now I have what? In addition to that, I've got 1,500 that cost me 34, all right? So the way that we need to be thinking at this point is we need to recognize something. And what is it? What I need to I recognize at this point. What is it?
All your purchases are going to be the same.
They're what though? What's happening to per unit cost? I'm buying from these people. Originally I got everything for 30. Now what? Now they're charging me 34. So I'm what? Period of rising costs. Okay? The input cost to run my business, whatever this inventory is, it doesn't really tell the office supplies, is going up. Alright? Now that indicates something to me, and we'll talk about what that should indicate a little bit later. Alright, so the June 10th transaction. We got our feet under us? We know what's going on here? Okay? Any of those numbers, you don't get. We're good? Okay, alright. June 28th, we have a sale. June 28th, we have a sale. We don't do anything in the purchases column. We go straight to the sales. Here's what we sold. 750 items at $50. Okay, so remember what I'm doing here. I'm concerned with inventory records. Okay, so, I'm selling to this group over here. They're buying 750 items at $50. Okay, so what I've got to do is, I have to go into my little store closet over here and sell them 750 units. As accountants, what we're concerned with is what? We're not as concerned with, well, we sold them 750 units at X amount of dollars. As inventory accountants, we're concerned with what? Okay, out of my two options here, 500 at 30 or 1,500 at 34, my question is what? Where did the 750 come from? You know, do they come from here, or do they come from here, or some combination of the two, which is perfectly okay. All right? So, if I am working under a LIFO assumption, that means what? The last ones that came in are the first ones that go out. Okay? So I have to start from the bottom and work my way up. All right? So, here's how you think through it. Out of these two, 530, 1534, which one came first? Which ones came first? Those came first. Okay? These came later, last. Okay? So these are what? When I make a sale, I'm drawing from this pile. Okay? So when I record this sale, I'm going to write 750, okay, at what? 34. Okay? 750 at 34. Remember, this is solely for the purpose of keeping track with inventory. I'm not recording sales over here. Okay? That's why I ignore that sales price. Okay? And notice I don't write 750 at 50. Right? I'm worried about what the inventory cost me. That's what I'm after. Okay? So 750 at 34 is 25.5. 25.5. Alright, so again, at the end of this thing, we always have to ask ourselves the question, alright, how did this transaction change my inventory? What's different about inventory after this transaction than before the transaction? So, do I still have that? You know, take it line by line. Have I still got that? Still got that, alright? So I still have 500 at 30 for 15,000. Have I still got this? Well, some of them. I had 1,500, but I did what? But I sold 750. Alright, so half of those I got rid of, which means what? I still have 750 left. It cost me 34. 750 times 34 is 25.5. Alright, so suppose I ask you this question. Remember, this is perpetual. You can tell me at any point, any date I give you, you can tell me the inventory balance. Okay? So, what is the inventory balance on June 28th? What do? We go straight here to our balance column, add up those two numbers, that's the inventory balance. Okay? If I ask you June 14th, well, there's not a transaction on June 14th. That's okay. The last transaction was June 10th. So whatever it was on June 10th is what it's going to be on June 14th. Okay? It's not, the balance is not going to change until some action, a purchase or sale or theft, forces it to change. Okay? Alright, June 30. June 30, we have another sale. On June 30, we sell 250 items. The selling price is 52, which is great. Alright? Fantastic. But we're concerned with what? We're only concerned at this point with inventory. How does it impact my inventory? So we have to ask ourselves a question. This 250, under an assumption of LIFO, says what? The last one's in, the first one's out. So what we're trying to determine as accountants is, out of these two options here, where did those 250 come from? Well, these were here before these, okay? So the 250 had to come from what? Had to come from here. Alright, so 250 at 34. 250 times 34 is, what, 7,500?
8,500.
So what I have left now, I still have the 500 at 30. Okay? And now I have what? Do I still have 750 down here? I just got rid of 250. So I got what? I got 500 at 34. 17. Alright, so June 30 balance, end of June. If I produce a balance sheet, inventory is going to show up on the balance sheet. Under the current assets, I'm going to have what? 32,000 showing on my balance sheet for inventory. Okay, so we're through June. We okay? Yes, sir.
It matters not what we sell it for.
Not here.
Only.
Not. We're only concerned with inventory. Okay, so how much do we acquire it for? When we get to the end of this thing, we'll talk about sales. Okay? All right, July 5. July 5th, we make another sale. We sell 100 units at 55, which means what? We got to ask ourselves the same question, all right? This 100 units, does it come from here or here? Well, under LIFO assumption, the last ones in are the first ones out. These stay. So that means all 100 come from the batch that cost me $34. Okay, so 3,400 there. And again, just like always, we have to ask ourselves, all right, what's left? All 500 at 30. You can see why grocery stores don't do LIFO in reality. Okay, you wouldn't want your last cartons of milk to be the first ones that go, because you're going to be stuck with what? Old cartons of milk. Okay, so that's why LIFO is hard in reality. And I also have what? Do I still have 534? No, I just sold 100, so I have 434. Okay? What's that? 13, 6. Good. All right. Now here's where things get funny. July 10. July 10, we make a purchase. 3,600. We buy 3,600 items. Is it 36? 36. All right. Total there is what? 126.6 or just 126? There. 35. Okay, that makes sense. All right. 3,600 times 35. Is that right? Is that good? Okay. Now that's one. Okay, that makes sense. All right. There. Good. All right. Now, all we did here was purchase. It's under the purchase column. It says purchase right there. All we did was add to existing inventory. Okay? So here we go. Do I still have those? Still got them. All right? So 500 multiplied by 30 is 15,000. Have I still got those? Still got them. All right? 400 times 34 is 13,600. And I did what? I added, all right? I added 3,600 at $35 for 126,000. Okay? So now I've got 3 layers. 1, 2, 3. 3 layers of inventory to manage. All right? Now, just because we go to 3 layers, and I think this thing eventually goes to 4, doesn't mean that the principles behind what we're doing change. It's still what? It's still LIFO. So anytime I make a sale from this point forward, I'm going to draw from here first. Then I'm going to draw from here. Then I'm going to draw from here. Okay? So, on the July 16th sale. July 16th sale. Here's what we sold on July 16th. We sold 1,800 items. So what? Start working here, right? Last in, first out. We start working from the bottom. You notice what? I've got 3,600 items that cost me $35. And those, since they're the last ones that I got, those are the first ones that are going to go out. Okay? So, this 3,600 can accommodate all 1,800. Okay? So, all 1,800, this July 16th sale, all 1,800 come from what batch? The 35. Okay? 1,800 multiplied by 35. 63? Yeah, 63,000 is left. Or 63,000 was sold, and 63,000 is left. Alright, so again, update. Don't forget that. Update. Those still there? They still there? Still there. Alright, 500 multiplied multiplied by 30. Still there? All 400 of those? Yep, still there. 400 multiplied by 34. What about those? We had 3,600. We just sold 18, so 1,800 are left. 1,800 remain. Multiplied by 35, and that is 63,000. We're updated. All right. So we're good so far, right? I throw one of these at you on the exam, you're just boom, got it. Good. Okay. All right. Last one for July. Sale on July 28th. We sell 1,700. Now we can start to get pretty good at this thing. All right, we know what? Last one's into, the first one's out, so I'm working my way up, right? I see 1,700. I've got 1,800 left that cost me 35. So I know right off the bat what? I know that all 1,700 cost, came at a price of 35. So I can record this sale, 1,700 multiplied by 35. 1,700. 59.5 is my number there. Okay? Remember to update. And then the question you ask yourself is, have I still got those? Still got those, right? All of these came from here. So I still have 500 at 30. I still got 400 at 34. And now I have what? I still got 18? Now I sold 17 of those. Right? So I got what? 1,800 minus 1,700 leaves me 100 at 35. 3,500. All right, I'm going over here. You keep working down. So you're good so far, right? We okay? Once you kind of catch on to it, it's starts to roll a little bit. It's catching on that makes it difficult. All right. August 5th. August 5. August 5th, we have a purchase. Okay, so let's, we've already got all these. So we're going to buy some more. All right? We purchased what? We purchased 3,000 at 35.80. So I'm going to go to my purchases column here. 3,000 times 35.80. A couple of things to check on as you work through here. We said initially that we're in a period of rising costs. Are costs still rising? Yes, costs are still rising. We've gone from 34 to 35.80 now. 3,000 multiplied by 35.80 is 107,400. So I have to update over here. So I ask myself the same questions. Have I still got those? Still got 500. 500 multiplied by 30. They're still with me. The 400 at 34. Still got those. 400 multiplied by 34 is 13,600. I still have what? I still got 100 at 35. And now I have what? Now I got 3,000 at 35.80, which is 107,400. So now I've got 4 layers that I'm working with. Are we good up here? I know I transferred from over here to over here. So we see what I did? All right. Any questions? 3, 2. Dallas just did a fake out. 1. We're good. All right. August 14th, sale. August 14th, we have a sale of 2,000 And remember, we're not necessarily as impressed right now that we sold it for $60. Our question as accountants is, all right, out of all these, where did the 2,000 come from? Under LIFO, start at the bottom, work our way up. So a sale of 2,000 says what? Here I got 3,000 at 35.80. So all 2,000 come from where? All 2,000 come from that 3,000 that cost me 35.80. So 2,000 multiplied by 35.80 is 71.6. Update our balances. Still have these. Still have those 434. I still have 100 at 35. And now, do I still have 3,000? I sold 2,000, so now I have what? Now I have 1,000 at 35.80. Now we're updated.
Quick question.
Yes, sir.
Is it supposed to be, is that just maybe transposed? Or maybe on the street or on the second line of 400? Is that saying 15,600? Second line?
13.
13, okay.
Yeah.
From here it's 5.
Yeah, 13.
Then do is 13.
Yeah. 13 is good.
Is this law of increasing opportunity costs?
Do what?
In economics, like the cost of the production of the sale?
Not precisely the same thing. Now, we could be buying more inventory. The question is, why am I buying so much freaking inventory? We got a ton of inventory. Why don't we keep buying? We might be taking advantage of economies of scale opportunity. That could be the case. We don't know. We're not privy to that information, but it's possible. Yeah. 25th. We buy more. August 25th, we purchased 500 at 36. So we have a very excited purchaser working for us. Now we have what? Still have all of these, and we have that. So we got 5 layers. 500 times 30. 15,400 times 34 is 13,600. 100 times 35 is 3,500. I still have 1,000 at 35.80, which is 35,800. And now I have an additional 500 at 36. They cost me 18,000. Now, big finish, August 30. August 30th, we make a sale, $1,750. And this one takes a little bit of work, so are we all on the same page up until this point? We're all good and happy and understand where all the numbers go. We're good. Okay, all right, so here we go. We sell 1,750 units. We are operating under a LIFO assumption. Okay, which means what? Out of this list of inventory, we start here with the last ones that came in and work our way up. Right? Okay, so 1,750, and you don't have to write this, but I just kind of do this as a guide. All right? 1,750 is my number. So what about those? All right, out of all 500 of those are gone. 500, so when we record this sale, 500 times 36 is 18,000. So we got rid of 500, which means what? We still got 1,250 to account for. So we know all those are gone. So we do what? Move up here. All right. The next level up is 1,000, 35.80. Well, we've got 1,250 to go. So what about these? All 1,000 are included in that sale. 1,000 multiplied by 3580 gets me to 35.8. So 1,000 more are gone. That leaves 250. So I've worked through this level. I've worked through that level. Now I'll bump up to this level. I've still got 250 to go, and I've only got 100 in this third level. So what about this 100? They're all gone. 100.
There you go.
100 times 35. So I sold 100 more. That leaves 150. So I've worked through that one. I've worked through this one. I've worked through that one. Now I'll go up here. I've got 150 left to account for. And I've got 400 at this layer. So that means what? All 150 come from this $34 group. 150 multiplied by 34. 50, 5100, thank you. 5100 is there. That accounts for the sale. Now I have to update. Those are gone. Those are gone. Those are gone. These, they're still there. All right, what we started with over there. All 500 are still there. What about this? This is where, some of the difficult. What about those? We had 400 before this transaction, but out of this 400, we did what? We sold 150. So 250 of those at 34 still remain. 250 times 34 is 8,500. 8,500. All right, now we've worked our way through the transactions. Here's one thing that I want to do. I'm going to keep this up. Here's what I'll do. If you go back to 7-1A, we go back to what we worked on Friday. Here's what we said. We said the inventory balance, ending inventory balance, when we get done, all right? Inventory, we said, was equal to 26,950. Agree? What is it today? Under LIFO, inventory equals what? Out of those, okay? So 5, 3, 23, 5. Inventory is 23.5. Now remember, we didn't change any of the economics of the purchases and sales. We didn't change dollar values. We didn't change anything. We just changed what? Accounting method, right? 7-1A, we did first one's in, first one's out. Here we did LIFO, last one's in, first one's out. And look what happened. We went from an inventory balance on the balance sheet of 26,950 to 23,500. The question is, why? And is it always true? That's the second question. The first question, why, is because we're in a period of rising costs. As long as we are in a period of rising costs, FIFO will always give us a higher inventory balance than LIFO. Why? Because when we do LIFO, we're getting rid of what? We're getting rid of our most expensive purchases first. Costs are rising. FIFO, we're doing what? FIFO, we're getting rid of the cheap stuff first. We're keeping what? We're keeping the expensive stuff. Alright? So, FIFO inventory in a period of rising costs, FIFO will always give us a higher inventory balance than LIFO. Always, 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 it's mathematically true. What if I have a period of declining costs? What do you suspect? Just, use the brain. What do you think happens? Complete opposite. Okay? In a period of declining costs, LIFO gives me a higher inventory balance than FIFO. Alright? Here's the other side of the equation. We said cost of merchandise sold. And remember where this number comes from. When I sell inventory, it becomes an expense. We don't record inventory as an expense until we sell it. Alright, so under FIFO, we had cost of merchandise sold of $290 450. Under LIFO, and just by way of reminder, where we get this figure is cost of merchandise what? Sold. So we go to our sales column and we add up these numbers right down the line. All the way over here, all the way down. When we do that, let me see if I wrote it down. I think 293,900 is the number I got. 293,900. 293,900. So if we do a comparison in a period of rising cost, which is what we have, all right, LIFO gives us a higher cost of merchandise sold than FIFO. Implications. Well, we talked a little bit about this last time. Either strategy works in a period of rising costs. Notice we have more expense here. More expense means what? Less income. Less income means less income tax. So, do companies use a LIFO accounting strategy during a period of rising costs to save on taxes? Absolutely. Yes, they do. To complicate matters even more, often firms will keep a set of tax books and a set of GAAP books, okay, to track the changes in taxes and stuff like this. And on the regular books, they'll use FIFO. On the tax books, they'll use LIFO because it offers a tax advantage. Okay? Now, for the records that we have to publish, the financial statements that go out to investors, we have to say as a company which one we use. Investors aren't idiots. They know the implications of how this thing works. So when we publish financial statements, we have to have a statement that goes along with the balance sheet that says, to calculate inventory, we used FIFO. Alright? So realize that I can increase net income just by doing what? Just by picking FIFO over LIFO at a period of rising cost. In a period of declining cost, I can increase income just by picking LIFO over FIFO. So companies that switch back and forth a lot, investors catch on to that. And what are you doing? Where you're not changing the economics of your business. You're not selling the good for more or selling the good for less or acquiring for more or less. You're just doing what? You're just jumping through accounting hoops to make yourself look more profitable. And it is possible, okay? But a sophisticated investor is going to know the difference in those two and be able to sniff that out pretty quickly. Our total sales is another figure I might ask you for. Very simple. All we do is what? Go to the sales column, or excuse me, we got to go back over here to our sales data. And this is where we bring in the actual selling price to these folks. This is where we're concerned about revenue. So all we do is we go and everywhere you see the word sale, you take that total, add it on. Sale. June 28th, sale, 37,500. June 30th, sale, 13,000. Add those two together. July 5th, sale, 5,500. Add it on there. The total that you will find for sales, and I'll do this down here since it's part of this. Sales is 483.8. 483.8. What was sales up here? 483.8. Okay? So the sales figure, we find sales where? Income statement, it's going to be what? It's going to be exactly the same. Okay? Sales, that record doesn't care whether you use LIFO or FIFO. The only account, there's two accounts that are impacted by this decision. Inventory and cost of merchandise sold. This is an asset that's found on the balance sheet. This is an expense that's found on the income statement. All right, so let's sort of put a couple things together and tie it all up. In a period of rising costs, so think of this as a test question. All right, in a period of rising costs, which method will give me a higher gross profit? All right, first thing we got to know is what's gross profit. Gross profit is what? Sales minus cost of merchandise sold. If we don't know that, we can't answer this question. All right, so in a period of rising costs, who's going to give me the higher gross profit? 483.8 minus 294.50 It gives me 193,350. $483,800 minus 293,900 gives me 189,900. All right, so here's our comparison. In a period of rising costs, FIFO will give me the higher gross profit. Why will it give me a higher gross profit? Because cost of merchandise sold is higher. Cost of merchandise sold is an expense. All right, so here's what we've done. We've looked at perpetual. We're not going to do weighted average perpetual. It's kind of dumb because you always know your balance anyway. When we come in here on a Wednesday, we're going to switch to periodic, different ball game. All right. This is perpetual. We did perpetual FIFO Friday. We did perpetual LIFO today. We talked about the implications of it. So be prepared for that. Know, in a period of rising costs, this, and this happens. In a period of declining costs, it's the complete opposite. Make sure you know how to calculate FIFO, doing that exactly right there. On test day, I'm not going to give you a problem that is this long, obviously, but you'll get some form of it. Okay, and I want to make sure you know exactly what's going on there. So Friday, periodic. We'll do periodic FIFO, LIFO, and average cost. It's not as complicated as perpetual. In fact, it's much quicker to do, but this is much more useful. And then we'll take the last part of it to talk about the test.
What chapter again?
Chapter 5, 6, 7.
We're gonna have to play this again.
Maybe. Like maybe it's saying, what?
Yeah.
That's it.